I'm going to take a slightly different tact. I'm going to come to you with more of a technology perspective because since we're talking about fast trading, we're talking about automated trading, black box trading, algorithmic trading. It's built on core technology. So what I thought I'd do is I'd perhaps spend about 3 or 4, maybe 5 minutes going over what the trends are, global trends and trends in Asia Pacific. And then go into a little bit of technology. So the entire presentation is about 10 minutes, and then we'll start the panel session. So this is a standard non-disclosure that every single Oracle presentation has. The reason this is in here, it's not required for the first half of the presentation, but towards the second half of the presentation when I'm talking about core technology, the last slide in this deck essentially talks about what our thought process is on what Oracle can do for fast trading for the front office in capital markets. Right. So these slides are completely messed up. Is there somebody here who can redo? The slide actually has about 7 or 8 bullet points, and you can only see the first one. So I'm not sure where the rest of the stuff is. Okay. All right. Well, it is what it is. Can I just get to the first slide, please, then? So anyway, the first slide was going to talk about global market trends. And what we've seen is an absolute explosion of data volumes. If I kind of rewind back to the 2007-ish, early 2007, late 2006 time frame, there's this options price reporting authority, OPRA, which sends n number of messages a second based on the options trading that's taking place. We were sitting in the 2005 time frame at about 60 to 70,000 messages a second, and within 2 years we increased that by an order of magnitude, right? So we ended up going to about 700,000 messages a second. Now, the financial crisis hadn't happened. We were expected that volume to continue to increase and go over 1 million messages per second by the time we hit about 2009. So we are seeing a lot of this happen, and in terms of regulation, because of Reg NMS in the US and MiFID in Europe, we've also seen fragmentation of liquidity happen. So we've seen that a lot of alternate trading sites, a lot of MTFs come up. And because of that, we start to see data volumes increase like crazy. In fact, 96% of ticks that you see on the NASDAQ are cancellations, right? Because these are algorithmic traders that are actually trying to get very, very close to their price, and they continue to trade and they cancel right before the trade actually gets executed to see if they can actually get a better price with the next tick. So it's things like this which is increasing the data volumes like crazy. So essentially what we're seeing is in the more established markets, exchange monopolies are giving way to fragmented venues, and you're seeing companies like Chi-X, Turquoise, Alpha in Canada, for example, taking away a lot of order flow from the more established exchanges like NASDAQ or like the London Stock Exchange. We are also seeing a change since the credit crisis of moving away from very complex structured products to more back to the basics, not just in banking but also in capital markets, so to more simple flow products, which are low margin products. However, the volume of these products, the volume that these generate on the markets are very, very high. Move from OTC to electronic trading, and you heard a little bit about this in the session prior to this session. Low volumes to extremely high volumes, high margin products to low margin products, and finally risk. Which is becoming more and more real time, right? It's becoming a pre-trade input as opposed to something that you compute at the end of the day. In terms of Asia Pacific, similar trends, however, it is about 2 to 3 years before where Europe was pre-MiFID, right? So what we are seeing is, again, in places like North America where you had Reg NMS and in Europe where you had MiFID, that was a cross-geography regulation which opened up the markets to various ATSs and MTFs. We don't see anything like that happen in Asia-Pacific yet. There is no cross-Asia-Pacific regulation that's come in that will allow the markets to open up. There is still a lot of protection of local brokers that we see, and which includes protection of the exchange monopolies. So 99+% of the trades in Asia Pacific are executed on the large exchanges. And contrast this to something like the United States, where about 50% of the trades are executed on the large exchanges like NASDAQ and NYSE, and the remaining 50% are executed on ATSs and MTFs. So this is a chart which kind of shows you what the maturity looks like of markets, and what you're seeing is the U.S. market trajectory, which is, if you can't read the bullets at the end, essentially what they're talking about is the definition of what a mature market is. So on the y-axis, what you're seeing is how mature a market is, and it's defined essentially as, greater than 25% of trading being done off exchanges. High-frequency trading, which is automated, so I'm not going to distinguish between, for this specific topic, between algorithmic trading and high-frequency trading. High-frequency trading is a subset of algorithmic trading, but high-frequency trading signifying, about 30 to 35% of order flow coming into the market. Internalization engines, dark pools being very, very prevalent in these markets, and then algorithms having the ability to sweep all of these different venues. So you're seeing the United States as kind of being the leader in this space, and then the Asian market trajectory being at the bottom. But what we are seeing, and you'll see this in the slides that follow, is that the Asian markets are slowly but surely starting to get to the place where the U.S. was about 6 or 7 years ago. In terms of electronic order book trades, you're seeing that prior to the crash, so that dip that you're seeing in that graph is the crash that happened in the middle of 2007. You were actually starting to see electronic trading starting to peak right now. Again, post-crash, we are starting to see the volumes go up again, but it will take a little bit of time. And this is the market fragmentation slide that I mentioned earlier on. In the United States, you see about 55-56% of trades being executed on NASDAQ and NYSE versus off-exchange. Contrast this to the bubble all the way on the right-hand side, or the pie chart all the way on the right-hand side, and you see that the off-exchange trading that is done in Asia-Pacific is about 1%, right? And this is primarily because of this slide, which is the latencies that you see. The latencies, and the dotted line is the 1 millisecond barrier, and what this is essentially are order book latencies, right? So what you're seeing is in venues like NASDAQ and BATS, you see 250 microsecond latencies, which are best case latencies or average latencies. They're all sub-millisecond. Whereas now if you start to move into Asia Pacific, and just to take an extreme example, if you go to the bottom right, you will see the Taiwan Stock Exchange with a latency of 20 seconds, right? So which is why you don't see that much algorithmic trading volume. As far as the innovation timeline is concerned, it's represented well as a pyramid, which is that you need to have some of these basics in place before you get all the way to the top of the pyramid, which is high-frequency trading, right? So that kind of is the nirvana of electronic trading, if you will. And at the bottom, connectivity, which was essentially the previous slide, right, which is latencies, to the venues where the actual trades happen. What sort of connectivity do you actually have? And as we've seen, it's in certain places, especially so if you go back about a year to the Tokyo Stock Exchange, we were talking latencies of single-digit seconds, right? So we had 1 to 2 to 3 second latencies that the Tokyo Stock Exchange had. But they've got a brand new equities trading platform that they've deployed called Arrowhead, and we expect the latencies to now be down into tens, if not